Hi everyone, welcome to a Q&A with Stan Weinstein. We're super excited to be doing this. And to kick things off, we thought we'd just kind of take it back to the very fundamentals and just kind of talk about how to overall identify the stages. So Stan, I'd love to kind of walk through this chart here of the S&P and just kind of talk about, the price action cues that you look for to identify what's a stage 1, stage 2, stage 3, and also the differentiations between, stage 3A versus 3B. Let's dive right in.
Richard, as always, you do a great job of leading things in. So here we go. First, it sounds at times almost too easy, and people want to make the game harder than it has to be. So don't get me wrong. Yeah, there's going to be some details along the way, but basically stocks usually, there are always exceptions. We'll go through stages 1, 2, 3, 4. First, let's talk in theory. In theory, stage 1, it's forming a base pattern. The 200-day moving average is still well above it, but this is important to differentiate. If the 200-day or even the 150 is well above it, you're still very early in stage 1. Then as the 200-day gets closer and you eventually break out of the lateral base formation and you also move above the long-term moving average, you're completing the stage 1 base, you're going into stage 2. Let's try and keep it simple. It's rising, yeah, there'll be corrections along the way, but as long as the corrections hold above the long-term moving averages, you're in stage 2. This is all good theory. Eventually, stage 3 happens when you now have had a big run. It's rolling sideways. And interestingly enough, in stage 3, the news will often be very positive. There was a reason why it had the big rally, and the stock is no longer making new highs on the good news. That's a warning. Then a bigger warning is when you start to break below the 50-day or 10-week, which is the same thing, moving average. Now it's migrating from late stage 2 into early stage 3. Eventually it breaks below the long-term moving averages. Boom, now you're in stage 4. So that's the theory. And I think it holds true after all the many years of looking at charts. I would say 80-85%. Yeah, there's going to be 15% that once in a while a potential late stage 2 will go back, from a 2B or even a 3A back into a late 2B. But usually it follows according to Hoyle, like in poker, and then eventually you break down into stage 4. Those are the important moves. Then from there, if you want to fine tune things, and sometimes I try to stick to the big things. People try to make it so perfect. They, just like with the market, short term versus long term, the short term is the 1, the long term is the 10. It's the same thing with looking at the chart and you're doing your tactics. Don't get me wrong, it still matters, but you can get so focused on the short-term moves, they sometimes miss the forest for the trees. So as long as it was going up and it's stage 2, that's fine. Now it breaks below the 50-day moving average, it starts to roll at stage 3. Then when, as I said before, when it breaks below the long-term MA, it's moving into stage 4. Now the converse, which we're going to in a minute look at a real life example, when you're in stage 4, and the stock has gotten slammed, eventually the news will be, of course, very bad. That's why it went down. Then it's no longer making new lows on the bad news. Mm-hmm. That's a hint. That's the only time I bring fundamentals into things. Then after that, you start to make a baby base, but it's not developed enough yet to be a full-fledged stage 1 stock. Then it finally, beside the little base, it breaks out above the 50-day moving average. That's what I call, and remember, we're fine-tuning things here, a 4B minus. When I put a minus onto a 4B stock, that's my designation for saying that I think you've seen the low for the cycle, and although it's not developed enough yet to be a full-fledged stage 1 stock, it can be a good trade. There have been a lot of them in recent months, like Netflix, etc. So that's the theory. Now let's take a look at reality. Let's put up a chart of DraftKings, and I think we can see exactly what went down with the DraftKings.
And Stan, diving a little bit more into that 4B minus setup, and now looking, as you said, at a real life example of DKNG. First, could you kind of define once again kind of that overall setup, and then also a lot of students had kind of questions about what having room to jam actually means. So I loved if you could kind of give a little bit more detail about that.
Beautiful, but I'm going to go back. I love your question, but I want to go back because I'm staring at this chart, and this is a Picasso. It's a thing of beauty. So if you take a look before you answer your question, I'm not dodging it. Take a look at the left part of the screen, you'll see, hey, it came out of a base. Boom, it did it stage one. It moved above long-term MA. It went into stage two. You had a beautiful run of the stock. Look how it then made that distributional top there. It looks to me like probably about March, April of 2000, and if I'm right here, of 2021.
Yep.
You start to roll sideways, you break below the short-term moving average. And understand, it's not going to always be perfect, but it happens often enough that all people should be aware of the game. When it's had the run and it breaks the 50-day MA, I'm robotic. I don't stop to think why, maybe this time it's different. It's the same way as when I'm playing blackjack. If I have 11, the dealer has a 6, I don't think about it, automatically double down. You're going to be right big percentage of the time. Same thing here. Yeah, there'll be exceptions, but you see after a beautiful run, you broke below the 50-day MA, a trader's out. An investor at the minimum has to start doing aggressive reducing. Boom. Then you see how it broke below the long-term MA. It really goes from A to B to C. After that, it broke the long-term A. Now the investors too are gone. And you see what happened thereafter. Yeah, there were a couple of phony moves up and down. But then once it broke clearly, you'll see that below. You spot that for me. It broke down. It's probably about November, I'm guessing. Go back.
Around 40.
Yeah. You'll see it broke the long-term MA and it broke that floor of support. The rest is history. Boom. Now we get back, Richard, to your terrific question. The stock got blasted and it followed the way it's supposed to do. And take a look. The other thing, show them, well, you're doing a heck of a job here, how even though the stock was destroyed, look at how all, as we're coming down, the contra trend moves failed very close to the 50-day declining moving average. Again, this happens so often. While life and the market isn't perfect, it happens often enough. We should all know the game. It did its thing. But now show them after you got, I'm guessing this is probably about late May, June-ish. Well, yeah, you got it. First, you don't know. Go in this absolute low. Yeah, you've got it. Beautiful. It hit that at that point. It's still stage 4B. Yeah, it's gotten slammed. It's laid into the bottom. But now this not only answers your question, which is a great question, but it really, everybody should follow it. I use the word feel very often. I can make anybody mechanical and sort of get it to a degree. But the ones who really become big winners get an intuitive feel. And that's what I'm now going to try to develop in everybody, the feel. It's kind of like, I always talk in analogies. So in analogous form, it's like when you're first learning to play tennis. In the beginning, you're like, oh, is it a forehand? Is it a backhand? But then after a while, it's intuitive. You don't think about it. Boom, it's a backhand. Well, that's how it is in the market. Take a look from that bottom that you spotted. At that point, it was terrible. Then take a look, Richard, a little to the right. You'll see the next time down. Look at how it didn't equal the prior low. Yeah. Okay, now we don't want to buy the stock, but a little suspicious. And if I'm short the stock, I'm starting to get a little concerned. And, profit taking is not a dirty word. Take some chips off the table. Then notice the next rally edges above the 50-day MA. That's a little hint. Then it comes back in. But now the third time down, and often 3 is a charm, the third time down, look at how, again, it held higher than the prior low. This is a market starting to whisper in my ear. You know what? As crappy as this stock has been, it's starting to make a little bit of a base here. Then take a look, and you're right on it, a little to the right of where you are. Now you break out above the 50-day moving average. Now this answers your question to a T, going from a 4B, which was late in the move, to a 4B minus. And I stress that this is not yet an investor's buy, but it is a trader's play. And in addition, even an investor who's short wants to know, like, you know what? I'm putting the chips in my pocket. I'm taking my profits. I'm moving on to look for a new DraftKings that was breaking down from the stage 3 top we spoke about before. Take a look and see how, You not only moved above the 50-day MA, a trader could put a toe in the water, but then show them, Richard, you have the little lateral, yeah, you're good, little lateral top there. You break out above that. Now you've completed the baby base. And now we go back to an earlier part of your assertion, which was right, that it's not enough. We want the baby base. We want to go above the 50-day MA, but sometimes you'll take a look and go, oh, you know what? There's a load of resistance just a point or two above us. So here's where I say, it's just like not all eggs are of the same quality, not all breakouts are the same quality. So the next part of this trilogy is we want to make sure that you've got room to trot on the upside. And you see there's no nearby resistance. The first thing you've got is that 150-day moving average, which is still a good trade. And when it broke through that, where did it stop? Not coincidentally, at the 200-day moving average, where the trader said, there's a word in Yiddish, genug, which means enough. It's genug. Boom. He's had the play from roughly 14 up to 21 and a half. That'll buy him lunch and dinner. He's out of there. And now you take a look, even though it corrected sharply, as you would expect, and that you're right on. And after that, where did it hold? Again, so many people think this is coincidence. Not coincidence. It followed the script perfectly. It held again at the rising 150 moving average, and you had another good trading pop up. Now again, it's getting hit. If it holds here again, that would be really beautiful. But to actually go into a full-fledged, right now it's in stage one. It's migrated from the 4B minus. It's now moved above the 150 and it's making higher lows. It's in a stage one base. Down the road, if we break out, and it may not happen for several weeks, but if down the road we close above, show them that high there at 21 and a half, you break out and close above 21 and a half, boom, that's into stage two. And I think then again, look for room to trot. I think that could have a big move. And this is another important thing. You're doing a great job showing that. So the upside is great. Also, the downside, there's good support beneath it. And that's what we always have to do. Don't only look at what could be right if we win, but also take a look at what kind of risk are we taking if we're wrong, which is going to happen in life. Only the liars are always right. This, I think, is a perfect illustration of how a market or a stock unfolds stage by stage. And again, as I said earlier, I hope I can inculcate a feel into everybody so it isn't just a mechanical ABC.